Hello, my name is Thomas Choi, Executive Director of KEPS Research, a joint venture organization between Arizona State University and Institute for Supply Management. We are here today with Professor Dale Rogers, who recently led a research team that looked at supply chain financing. Supply chain financing looks at the movement of money behind the scenes in supply chain. We collected data from major banks, non-traditional lending agencies, fintech companies, as well as Fortune 500 type major companies. Two other research members were Professor Rudy Leuschner of Rutgers University and myself from Arizona State University. So Dale, we've heard so much about supply chain financing. Would you tell us, in your own words, what that actually is?
Well, our definition of supply chain financing is using the supply chain to fund the organization, accessing capital, unlocking capital that's in the supply chain to help the organization achieve both growth goals and profitability goals. And sometimes, more rarely, truthfully, is using the organization to fund the supply chain. So to maybe backstop to improve the health of suppliers, you use some of your financial management capabilities and access to capital, and you help your supply base out, or maybe even going forward through the sales channel.
Okay, that's great. Then what would you say some of the primary motivations were when you began the research?
Well, there's three primary flows in the supply chain. There's the product flow and the information flow. And, there's been a lot of research on both of those. The financial flow, there hasn't been as much research looking at that. And it's really the mechanism that often structures the other two. It structures the other two flows within the supply chain. And so really examining those financial flows and seeing what, companies that are good at managing those financial flows and how they structure the other two and how they allow a firm to be very successful both selling products and services, and also on Wall Street sometimes. It's an important thing to really understand. And too often supply chain managers really only focus on the other two and the cost of those other two. And really we're looking at supply chain management. We're saying it's not just about make, source, deliver anymore. It's also about paying for things in the supply chain, and it's an important financial instrument, I think.
That's great. Now, having talked about the definition of supply chain financing as well as primary motivations behind the study, suppose a company is convinced and this company wants to implement supply chain financing. What kind of potential gains could they be looking at?
Well, a very important one is funding the growth of the company, maybe funding it in non-traditional markets. Like there's a lot of KAPS members and other firms that, maybe their growth is almost tapped out in their traditional markets like North America or Europe. And they're looking to non-traditional markets, sometimes non-traditional products, to grow because you got to keep growing. And so they're unlocking capital in the supply chain to enable this growth, because you've got debt capital, you've got equity capital, you always have cash, which is great, but you got to generate that cash somehow. And so the other type of capital is operating capital or supply chain capital. And in many ways, that's the cheapest source of capital. Mm-hmm. That's the best mechanism to really use to grow throughout maybe the rest of the world that you're not operating in right now.
Mm-hmm. That's great. So would you be able to offer us an example?
Yes, and the example you see behind us on on the screen is a real life example from a consumer products company that you and I got to go visit a while back. And what are some of the sources this company uses to develop supply chain capital? One of the mechanisms they use is pricing. So they will adjust their pricing up sometimes, and they are able to do that, this particular company. For some firms, pricing is sort of a given, and they can't adjust that. SKU rationalization, where they're always looking at the products they are selling to see if those products are still viable in the marketplace, and they work very hard at pruning offerings and reducing the number of SKUs, because they're always adding SKUs, and so there's a mechanism to reduce those. That's another source of supply chain capital. Mix management, what's the mix that you're going to market with? Supply chain savings, and of course every buddy watching this video is probably thinking, well, I'm already trying to get supply chain savings. But if you think about one of the purposes of supply chain savings is not just to make you profitable, but it's a financial instrument to really help you fund the corporation. And then functional savings for this particular firm. And you're looking for the organization, and this is a company that's growing very rapidly and has had to redo its organizations many times. And they're looking for, well, maybe we can save money in the functions and how we deal with our supply base and so on. So this is a real life example of what some of the sources of supply chain capital, and there's probably other ones as well, but this is a real example of how you would use your supply chain to develop savings that will allow you to fund other initiatives.
Thank you. That was a great description of how a company is actually creating savings out of their supply chain. Now, earlier we talked about, some of the major players in supply chain financing. Would you be able to go over them briefly? Yes.
So this is really interesting, and I think for all of us on the research team, we learned quite a bit. Banks are so important. They're really the heart and lungs of the global economy. And when the last recession hit in 2008, 2009, some of those banks were literally too big to fail because they are financing, their trade financing arms are financing suppliers all over the world. And so many of the banks are participating and trying to make it easier for suppliers to supply their customers. One of the things that's happening the last few years that probably not everyone is happy about is that payment terms are being extended. Many firms are moving their accounts payable out. That's a huge burden on small and medium-sized suppliers, maybe even large suppliers sometimes. And so the banks have developed supply chain finance programs to help ameliorate that a little bit. The second bullet on the slide behind us was really interesting, I think. FinTech, which stands for financial technology firms, have entered this marketplace. And they act as platforms that facilitate interactions between buyers and suppliers, buying firms and supplier firms. And they sometimes have a funding mechanism built into those companies. And while they're not a bank, they will figure out places to get funding to, again, help supplier firms get paid quicker and stay healthier. Both banks and the fintech firms are really enabling some of these supply chains where the buying companies are extending their payables, or the suppliers aren't incredibly healthy just to start with. They're enabling these companies to thrive. And the last one are non-traditional funders. So one of the interesting things that we found out is that there is a lot of money on the sidelines to invest in different types of investment. And some of the supply chain finance opportunities, which tend to be short-term, very high quality sort of payables, receivables, they're payables from maybe a large organization that's financially strong. And so once those payables have been approved, once the invoice is approved, those receivables almost end up as like commercial paper. And so there's non-traditional funding organizations, non-traditional funding companies, lots of different stripes. Some of these are insurance companies. Some of them are specialists, just funding firms. Some of them are pension funds even. And these short-term payables/receivables are very high quality. They seem like a sure thing with low risk, and they pay off quick. So, maybe a firm is paying their bills in 90 days. The supplier wants to get paid in 15 or 20 days. So you've got 70 or 75 days of a short-term kind of loan there. And you can actually get a return on that and get your money out. So it's a really interesting ecosystem that has been around for a while, but there's lots of new types of companies entering into this marketplace. And certainly supply management executives should be aware of what's out there.
Yeah. So major buying companies, perhaps through supply chain financing, can get savings out of supply chain. But at the same time, suppliers could also benefit by knowing exactly when they're going to get paid.
That's right. Because what happens is that you're taking risk out for the suppliers, also by sometimes enabling a third party such as a bank. You're actually making the transaction more standardized, so you're going to get paid exactly on day 15 or 30 or whatever it is, as opposed to, well, I think the check's in the mail kind of thing, which can be sort of variable. Right. So these financial third parties, the banks, the fintechs, are really helping to structure some of those transactions and making them less variable and more dependable, reliable for the suppliers.
So let's take out the uncertainty
from
the suppliers.
Yes.
So having said all this, and we need to wrap things up now.
Yes.
What would you say some of the major findings were?
Well, certainly one of them is that the cheapest capital can be found in the supply chain. If you look at other sources of capital, you got debt and you got equity, but some of the best capital can be found in the supply chain. Supply chain management isn't just to make, source, deliver. It's also now to fund the organization. And it's always great to have just cash laying around, but if you're trying to grow in maybe new markets or new types of products, getting capital out of the supply chain is a good way to go. Firms are looking to an efficient and effective supply chain to really fund the growth of the company. So innovative companies are starting to look at their supply chain as the source of capital where we can grow. Maybe we don't have a lot of operations in Africa, but maybe that's where we're going to go. And then the third finding is that companies can't only be dependent on revenues and financial management, financial gains to grow profit. We really are looking at the supply chain where many of the assets, sometimes the majority of assets, are housed, to be the engine to make the company profitable and successful in both the short and long term.
That is great. Thank you, Dale. The full report contains a list of various supply chain financing techniques companies use. Please do come visit us at the webpage we show on the screen behind us. Thank you very much.
Thank you.